Imagine a product that costs absolutely nothing to manufacture, a product that never runs out, a product that somehow becomes exponentially more valuable the longer people hold on to it. It is not oil, it is not gold, it is not data. That product is debt. For most of human history, debt was viewed as a moral burden, even a curse. Entire religions warned against its practice. Leaders occasionally canceled it in great acts of amnesty. Ordinary people feared it because they knew it carried chains. Yet, today, debt is the very foundation of the global economy. It drives profits for the world's largest banks, builds fortunes for investors, and dictates the daily choices and long-term destinies of billions of people, including yours. How did we get here? How did we transition from neighbors lending each other grain for a season to Wall Street transforming trillions of dollars of personal promises into abstract, untraceable assets? The story of debt is not merely an economic history. It is the shocking, unsettling story of power, control, and the invention of the most profitable financial product in human history. And once you understand the mechanism, you will see your mortgage, your credit card, and your government's balance sheet in a radically different light. We begin 4,000 years ago in ancient Mesopotamia, the cradle of civilization. Here, debt was literally written on clay tablets, records of farmers borrowing grain to plant crops or tools to harvest. In this world, debt was a lifeline, a communal promise designed for survival, not massive profit. If a farmer experienced a failed harvest and couldn't pay, he wasn't immediately ruined. Rulers understood a crucial lesson. Too much debt meant social collapse. If too many citizens were crushed by obligations, the whole system risked revolt. So, ancient kings often declared periodic debt jubilees, wiping the slate clean to keep society stable. Debt forgiveness was not charity. It was a survival strategy for the state itself. It was about balance, ensuring the community could move forward. But the moment money became standardized, moving from ephemeral promises written on clay to durable, measurable metal coins, the nature of debt began to transform. It stopped being merely a promise. It became measurable, transferable, and eventually highly profitable. And once society realized debt could be measured, financial elites figured out how to monetize the interest. Fast forward to the Roman Empire. Rome took the foundational concept of debt and sharpened it into a weapon of control. Borrowing was no longer just a favor. It was enforceable with brutal, systemic consequences. Citizens who defaulted could lose their land, their property, or even their freedom. Debtors could literally be sold into slavery to settle obligations. The Roman elite learned early on that lending was inherently political. They realized that credit offered a powerful tool to manage and control the population without deploying soldiers. The concept was simple. Keep the citizens owing, and they will keep obeying. The Latin word obligatio itself meant both debt and bond, implicitly stating that there was no difference between the two concepts. By the height of the Republic, the system had successfully hollowed out the Roman middle class, the very backbone of the army. Small farmers were crushed by debt and forced to sell their land to wealthy creditors. This created a crisis that fueled political instability and eventually led to the rise of emperors. Emperors, facing massive military costs and a populace demanding perpetual benefits, didn't fix the dependency. They amplified it. They used debt, much like modern governments use fiscal stimulus, to buy loyalty and delay the inevitable collapse. The irony is eternal. The empire with access to infinite conquest wealth was always structurally bankrupt, addicted to borrowing to survive. Debt had graduated from a tool for agricultural survival to the engine of state control and wealth concentration. Yet even during the Middle Ages, the moral argument persisted. The Catholic Church formally condemned usury, the charging of excessive interest, but financial elites always find a way around moral rules. Merchants disguised interest as fees, penalties, or complex exchange contracts. Banking families like the Medici in Florence built empires by financing kings, popes, and wars, exchanging loans for immense political leverage. They proved that money was power, and that control over credit flows was more valuable than controlling gold mines.
The true transformation of debt from a tool to a mass-produced product occurred in the 20th century. After World War II, the global economy surged, driving an explosion of consumer culture. People wanted cars, televisions, and suburban homes. Banks immediately saw the opportunity. Why wait for people to save when you could lend them the money right now and charge them for the privilege? This was the birth of consumer debt as we know it. The 1950s brought the first credit cards: Diners Club, American Express, Visa, MasterCard. Debt was no longer something you begged your local banker for. It was something you carried in your wallet, advertised as freedom and lifestyle. The stigma vanished. For financial institutions, this was revolutionary. They began profiting not just from the interest on large corporate loans, but from a constant compounding stream of small fees, penalties, and late charges from millions of households. Debt became mainstream, and banks realized they made money at every single step, not just when a customer defaulted. Debt had morphed into an infinitely scalable financial product. But the ultimate invention was still to come: the ability to sell debt itself. In the late 20th century, financial institutions discovered financial alchemy. They realized that they didn't have to hold the loans they issued. They could package thousands of mortgages, car loans, or student loans together and sell them to global investors as mortgage-backed securities or collateralized debt obligations. Debt was now a commodity, traded globally like oil or wheat. This system's genius, or its danger, was that lenders no longer cared deeply if the original borrowers could repay. Their profit came from the fees generated by selling the debt and passing the risk to someone else, the investor. Wall Street had found its golden goose. As long as people wanted homes, cars, or education, there would be loans. And every loan could be sold, rebundled, and traded multiple times, generating infinite profit streams from finite human obligations. Today, debt is more common. It is expected. Want an education? Student loans. Need a car? Auto loans. Want a house? A mortgage. Credit scores, a 3-digit number, became the gatekeeper of modern life, dictating access to housing, jobs, and insurance. The system is designed to keep you hooked. Customers who pay the minimum balance but carry revolving debt, often at interest rates exceeding 20%, are the perfect customer. Debt is the foundation of the modern economy, and it operates under a non-negotiable rule: it must keep expanding. Since 1971, when the United States severed the dollar's final link to gold, money itself has been born as debt. The vast majority of dollars in circulation are created when banks issue loans. If people stop borrowing, the money supply shrinks, the economy stalls, and jobs vanish. That is why central banks panic when credit slows. They cut rates, print money, and beg for more borrowing. The entire system is a financial shark. It has to keep swimming or it dies. This endless expansion, however, comes at a devastating cost. Number 1, systemic fragility. The pyramid of leverage grows taller with every crisis. The 2008 financial crash was the inevitable result of debt stacked on debt. When the housing market collapsed, governments didn't reduce debt, they multiplied it, printing trillions for bailouts, proving that the system is rigged to protect the powerful at the expense of the public. Number 2, wealth extraction. Debt creates profound inequality. Wealthy borrowers qualify for the lowest interest rates to acquire appreciating assets, stocks, real estate. Struggling families face high interest on survival debt, credit cards, medical bills. Every interest payment is a continuous, invisible transfer of wealth from the debtor, the many, to the creditor, the few. The difference is that Rome's creditors wore togas and ours were suits. Number 3. Sovereignty loss. Debt acts as a powerful political weapon. Nations drowning in loans are forced to accept austerity programs dictated by international creditors, IMF, World Bank, losing control over their budgets and domestic policies long before they technically default. Debt, therefore, has reached unprecedented scale. Global debt now exceeds $300 trillion, or roughly 350% of the world's annual output. It is mathematically impossible to repay without some form of major reset, typically through inflation or default. The invention of debt, the transformation of a promise into an infinitely saleable, scalable, and self-compounding financial product, is truly the most profitable human invention ever. It requires no factory, no resources, and no innovation. It generates wealth purely out of time and obligation. The result is a civilization tethered by invisible chains. The final realization is unsettling. The next time you swipe a credit card or sign a mortgage contract, remember that you are not just buying a product. You are the product. And the system has been designed for centuries to profit endlessly from your future. History teaches us the brutal lesson. Debt builds power, but it also dictates destiny. Every empire that prioritized endless borrowing over financial discipline eventually faced a reckoning. The question for us today is whether we recognize the chains before they tighten completely, or if we will, like the Romans, mistake our debt addiction for prosperity until the illusion shatters.